This is Ken Boyd with St. Louis Test Preparation. This is another in our series of intermediate accounting videos, financial accounting videos. Financial Accounting A, Trading Securities. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, St. Louis Test Prep, the website, and the book, Cost Accounting for Dummies, that I teach online in a weekly live chat, and you can email me if you'd like to attend the live chat. I am going to change this to intermediate accounting. It's more of an intermediate issue. And what we're talking about is when you have an investment in securities and you are changing the type of investment between available for sale, held to maturity, and trading securities. So what I have is a tab for each type of transaction. So the first one is AFS stands for available for sale, changing from an AFS security, available for sale, to a trading security. The general rule is that available for sale securities are reported at fair market value, and that if there's an unrealized gain or loss, it gets posted into other comprehensive income. I'm going to put that in parentheses. Other comprehensive income. It does not go into the income statement per se. It goes into a separate section of the income statement. So let's then talk about, well, what happens when I change from available for sale to trading? What this says is when the equity securities are transferred from available for sale to trading, the unrealized gain or loss on such securities based on fair market value should be transferred from OCI and recognized in income immediately upon transfer, because trading securities, as we'll find out later, their unrealized gains and losses go straight into income. So since you're switching to a trading security type, the research says that we recognize the income immediately when we transfer. So here's our transaction, and this is going to be the same transaction throughout all these examples. 1-1, we purchase an available for sale security for $10. So we create an asset, investment and available for sale, and we pay cash, we credit cash. On 12/31 of year one, the fair market value goes up by $10. It's a $10 increase. The fair market value of the security increases to $20. So what do? Well, you can see that we do two things. We do a fair market value adjustment, debit, and we have a credit, unrealized holding, in this case a gain, on AFS. You're going to see a T account at the bottom of the screen here to account for all these changes in fair value and unrealized gains. 12/31/14, value of the security goes down by $5 from 20 to 15. We debit unrealized holding loss in this case. We credit fair value to reduce it. Then on March 3rd, it says the fair market value is now 25. It's $10 higher, and we change from available for sale to trading. I would suggest you do this in two pieces. The first piece is bring the existing security, which is the available for sale security, and make all the adjustments and bring that security up to date, up to where it should be as of March 3rd. So the value of security increased $10. Unrealized gain $10. Fair market value adjustment is debited. So now we've brought the AFS security up to date where it should be as of March 3rd. The next step is we move the security from AFS to trading. So it's a three-step process in the journal entry. We create a new asset account called investment and trading security. We debit it for $25, which is the fair market value of the security on 3/3, $25. We take the investment off the books, the investment and available for sale at $10, which was our original cost. We need a $15 credit to make everything balance, so the fair market value adjustment account gets credited for $15. And really the reason for this entry is that because we no longer have an AFS security, that fair market value adjustment account needs to be credited to 0. There's another part of the entry too. If you look at slide down, we take the unrealized, in this case a gain, we debit to remove it $15 out of AFS, and we credit income. Now, what we probably should do here is just call this a gain on sale of a security. $15 so that unrealized gain goes straight into income. So now we have, now we've done two things. We've removed the available for sale security. We've set up a trading security, debit, and the unrealized gain or loss has been moved into an income account by crediting. Now when we go forward, let's say the value of the security goes up another $7 from 25 to 32, we recognize unrealized holding gain right into income because now it's a trading security, and the security fair value adjustment account is increased as well. Let's do one other one, which is going from available for sale to going from hold to maturity, to available for sale. Now, hold to maturity is only a type of valuation for bonds. It doesn't exist for equity because equity securities by definition have an unlimited life. So there is no maturity date for common stock. There is no maturity for an equity security. So we report those equity security, those hold to maturity securities at cost. Think about buying a bond. The unrealized gains and losses are not recognized. So 1-1, we purchase a hold to maturity security at 10. Investment in hold to maturity security, it's an asset. We credit cash, $10. And you'll notice as I slide down that along the way, when the value of the security changes over time, we don't make an entry because it's a held to maturity security. We don't adjust for fair market value. Now we move the security from hold to maturity to AFS. We create an investment in AFS account for the $25 current fair market value on March 3rd. We take the hold to maturity security off the books by crediting. It's now removed. And we credit unrealized holding gain or loss on available for sale because now this is an available for sale security and we need to post that adjustment. Finally, going forward, if the price, for example, increases from 25 to 32, $7 increase, we increase the fair market value adjustment account, AFS. It's an AFS security now, 7. And we credit the unrealized holding, what would in this case be a gain, another $7. So what we've done in this video is we did a change from a hold to maturity to an available for sale transaction. And we did, if I scroll to the top, an available for sale to a trading security example. And I'll notice one other thing at the bottom here. You'll notice that in order to keep these things straight, I set up T accounts for the fair market value adjustment account and for the unrealized holding gain recount. So if I had to close these accounts, I knew what the ending balance was at 3.3, fair market value adjustment debit, unrealized gain credit. So if I close the entries, I know I need a credit for the fair value account and a debit to close the unrealized gain account. So that was what I did at the bottom of the page, and I've done it for some of the other examples you'll see later. That's as far as we're going to get for trading security gain loss. Remember that our toughest accounting topics are topics that I get asked about the most. I teach on an ongoing basis. These dates are always updated. They're small group live chats. You can email me for more information. And finally, the book, Cost Accounting for Dummies, is something that I teach online about every week. We cover about a chapter a week, and you can email me if you'd like to attend that free course. Thanks very much for watching, and we'll see you next time.